Right. Good evening. So, welcome to our class today on FAC2601, and which will be our final class before you go for the test. And I think I managed to cover the things that we are supposed to be writing through the questions, as the other topics were coming through other questions. So, I hope you will be able to apply them in your main test. Right. So today we're going to continue so that we can be able to do the statement of financial position part. We did the property, plant, and equipment note. Right. Our question wanted us to do the statement of financial position, looking at the asset section, and also to do the PPE note. So this was our required. Disclose the notes, the following notes to the annual financial statements of Pro Works Limited at 28 February. The property, plant, and equipment, a total column is not required, and the investment property. Right. So we did our property, plant, and equipment with land and buildings, land, building, plant, and machinery. Right. And then we were told that on the additional information that the following information relates to owner-occupied land and buildings. On 28 February 2013, Pro Works Limited acquired a factory and offices situated on ERF 401 Boom Street to be exclusively used for their own purposes. The property was available for use as intended by management on acquisition date. On acquisition date, the useful life of the buildings were estimated to be 20 years, and a residual value of nil was allocated to the buildings. Both the residual value and the remaining useful life of the buildings remained unchanged since initial recognition. Then on 1 March 2016, an independent sworn appraiser, Mr. J. Leon, revalued this property for the first time and determined the fair value of the land and the net replacement value of the buildings to be 600,000 and 6.4. Right, these things led us to recording this, making these calculations. We had to calculate the land, and we found the revaluation to be 200,000. And we calculated the building. We had the cost, accumulated depreciation, then we revalued the building, then we also calculated the depreciation for this current year. Those were our calculations on the land and buildings. Right. Then we went to the next one, which was the following relates to the investment property. On 1 March 2016, Pro Works Limited acquired a property situated on stand 65 Fordsburg at a cost of 3.2 million, land 1 million, building 2.2 million. Additional expenditure of 30,000 was incurred to secure the two tenants that occupied the building since the date of acquisition. Improvements to the building to extend the rental flow capacity amounting to 400,000 were completed on 28 February 2017, including repairs and maintenance of 50,000. Remember, we said in the cost of the building, we won't include the repairs and maintenance. Right, on 28 February 2017, Mr. M. Owner, an independent sworn appraiser who holds a recognized and relevant professional qualification and has relevant experience in the location and category of the property being valued, determined the fair values of this property as follows. There was land and there was a building. Right. So we dealt with this investment property. We then made our calculations. We found that this investment property, there was a fair value adjustment on land of 100,000. Then the building, the improvements are added to the cost. We then calculated the fair value adjustment on the building, which was 450. Right. Then number 3, all delivery vehicles were acquired on 1 March 2014. We don't even, or they are not even up there. And they were all available for use on this date. A residual value of new was allocated to all delivery vehicles on acquisition. Right, the carrying amount of delivery vehicles on 1 March 2016 amounted to 960,000. The following deliveries were acquired, delivery vehicles were acquired and sold during the current year. Right, we managed to determine the original cost of the vehicles by using original cost price. We found it to be 1.6, since we saw that the original useful life was 5 years and already 2 years had gone. So that's why we multiplied by 5 divided by 3 to get the original cost. Then we calculated, our depreciation for this current year. Then we also calculated our disposal, that is the asset which was sold, right? Because we were told that on 31 August, one of the delivery vehicles acquired on 1 March 2014 with an original cost price of 240 was sold for 200,000. The accumulated depreciation of this vehicle on 1 March amounted to 96,000. You have to know that even if an asset is sold, we still provide for depreciation for the months that we used it. Remember, our year started on 1 March 2016, and this asset was only sold on 31 August. So we provide for depreciation from 1 March, the beginning of the year, up to 31 August. Then the next thing, we also have to remove that asset from our books. We have sold the asset. Because we've sold the asset, we no longer have the asset. So it has to be removed from our books as a disposal. So we had to record our disposal. So we recorded, we then had to calculate our disposal, and disposals are recorded at the carrying amount of the asset on the date that it is sold. So we calculated our disposal. This was our disposal. Right. Then finally, then there was also a new delivery vehicle which was purchased at 10,000, 14% VAT included, to replace the above mentioned delivery vehicle, and it was immediately available for use. A residual value of new was allocated to the delivery vehicle on acquisition date. You can assume that ProWorks Limited is a registered VAT vendor. Right, the cost price, remember, it should exclude VAT. So we had to calculate the cost price excluding VAT. In fact, that's what we found the addition here to be 360. And we calculated its depreciation for 6 months. That is the months that from the date that it was bought up to the end of the year. Right. Then we also had plant and machinery, which were given there that the cost was 1920 and the accumulated depreciation was 384. But then we're told that on 1 September, ProWorks purchased a new machine at a cost of 600,000. The machine was available for use as intended by management on acquisition date. On acquisition date, a residual value of 40,000 was allocated to the machine. So this was the addition, the 600,000, and we also calculated the depreciation on the machine. So our depreciation, it was here. We found it to be this one here. Right. So now we have to prepare the notes to the financial statements. Right. Are you now in the picture of what we were doing last week? Here we did everything. I was just trying to recap so that when we answer, we're not totally lost.
Yes, sir. Yes, sir. I don't really see the problem. Although there's something, I'm not sure if I'm taking you back, where we're dividing by 3. We had 5 years, and why did we divide by 3, Ghana?
Because we're saying this 960 is the remaining portion that will be depreciated over 3 years. So the 960,000 represented 3 years because 2 had gone here. From 1 March 2014 up to 1 March 2016, 2 had gone. And we're told that the original useful life was what? 5 years.
Okay.
Is that right?
So we're dividing
that means the 960 is for 3 years. So we are trying to determine the original useful life, so that's why we have to take it back like that.
Okay, so thank you.
Right. So now we do our notes. We'll do an extract of the notes, the financial statements. Of ProWorks Limited. For the year ended 28 February 2017. Right. Number 1, property, plant and equipment. Right. So we'll create a column for each and every asset category. We have land, we have buildings, we have plant and machinery, we have delivery vehicles. We always start with our carrying amount at the beginning of year.
Sorry, sir, I got disconnected, but I'm back.
Okay, yeah, back. I didn't see it that way out. I was busy there. Right. So I was saying, but I just written the heading. So we have to create a column for each and every asset. So I created a column for land, buildings, plant and machinery, and delivery vehicles. So each class. Then when we start, we should start with our carrying amount at the beginning of year, which will be made up of the cost and the accumulated depreciation. Right. Our land, remember that the cost was 400,000. It was only revalued during the current year. So our cost was 400,000. So by the beginning of the year, it was just 400,000. And there is no depreciation on the land.
Mm-hmm.
Right. Then on the buildings, our cost, we calculated it here. But it was given the 6398. Can you see it?
Yes, sir, I can see it.
Then our accumulated depreciation, we also calculated it, which was this one.
Yes.
Is that right?
Yes.
Right. Our plant and machinery, our cost at the beginning of the year, maybe we have to calculate it here. Right. We know that our machinery, we are given that it's a 1920, and this balance is, it's on 1 March 2016, so there might be an error on the depreciation. It's on 1 March, so it's 1920.
Yes.
Right, this balance is, so we made a mistake on the depreciation because these balances are at the beginning of the year, 1 March. Can you see they said that the following balances were on 1 March?
Yes,
so we made
sir.
a mistake on one of the calculations. So it should be, so this one is the opening balance, which is the 1920, and the depreciation then it was 384. Is that right? So it will be 120,000 and 384.
Yes.
So when we go to the depreciation of the plant and machinery, we should do a recalculation. There was an error that we did there. Then our delivery vehicles, we calculated the original cost. which we found to be what?
Let's see.
This one, 1.6. Is that right?
Yes, yes.
And we know that the carrying amount at the beginning of the year was 960. We're given, isn't it?
Yes.
This one we're given the carrying amount here. The carrying amount of the delivered vehicles on 1 March was 960. So if we now know the cost and the carrying amount, we can simply find the depreciation, the accumulated depreciation by finding the difference. Is that right? So that would be equal to this minus that. Any questions there?
No.
Right. Then we'll have a revaluation during year. There was a revaluation on the land and a revaluation on the buildings. On the land, we found the revaluation to be 200,000. And on the buildings, we found the revaluation to be, but they no longer, I don't think they will examine you on the revaluation of the buildings. They would usually only examine you on the revaluation of land these days. Right? The building, the revaluation was 961,360. So we'll have 961,360. We have 200,000. Right, as you can see, I didn't put the total because they said that the total can be ignored. But if they said the total should be included, we're going to put the total there, or if they not said anything.
Yes.
So if they don't say anything, you include the total.
Yes.
Right, for the total, you just add up the columns.
Yes.
Right. Then we have additions during here. Right. On the land, there was no addition. But on the building, I think there was an addition, if I'm not mistaken.
Let's see.
No, there wasn't. The building. I don't remember. I think there was no additions on the building.
No. Sounds as if there was none.
There was nothing. Right. But with additions on the vehicles.
Yes.
They bought a new vehicle, this one here. But we have to take out the VAT. And they also, oh no, was it this one? Yeah, that's it. Then they also have a new machine for 600,000.
Yes.
Right. So our additions, we have 600,000 here. And here we calculated it here. 360. It included VAT, so we had to take out the VAT. So it was 360 after taking VAT. Right. Then we've got depreciation for the year. Right. On the buildings, we calculated our depreciation. It was this one here. On the plant and machinery, that's where we have to sort it out. Yes. Right here, we said the old machinery, we subtracted the new one, but this one we could have subtracted if the balances that were given were at year end. But here they specified that the balances were on 1 March. So they were at the beginning of the year. So there was no need to subtract that 600,000. So there was no need because these balances, can you see here? These were at 1 March before they added the new one. But if these balances were at 28 February 2017, that's when we're going to take out the 600,000. So there was an error. We assumed that the 1920 includes the new asset.
Okay.
So here the new asset was not included because these balances were at 1 March. If you can see, they are saying these balances were on 1 March, isn't it?
Yes.
It was before the purchase of the vehicle. The new vehicle was bought on, the new machine, sorry, was bought on 1 September. So it was not included in those balances. Is that right?
Yes.
I assumed that it's included, which was wrong. So can you recompute this figure here?
1, 0, 1, 2, 3, 2 minus 3 is 4, 1, 2, 3. 1536000.
Wait, just a second. You found what?
1,536,000.
No, it can't be 1 million. Did you take into account the 20%?
Oh. 307,200.
307,
Yes.
200.
Yes.
Right, so that would be the depreciation, the correct depreciation. So here on the plant and machinery, it will be equal to that one. And on the delivery vehicles, this one here, we calculated it here. This one is okay. Right. Then we'll have our disposals during here. Disposals are assets that were sold. Now they sold a delivery vehicle. At its carrying amount, we calculated the disposal here. Is that right? Right. So those are all the things that we had on the movements in assets.
Yes.
Any questions?
No, sir.
Right. Then we find our carrying amount at end of year. Right. Then we include what? The cost.
Cost in the cognitive depreciation.
But here it's no longer be the cost, it is cost of gross carrying amount. Why? Because our land and buildings are no longer at cost. As long as there's a revaluation, it's no longer just cost, is cost of gross carrying amount.
Okay.
So you only say cost of gross carrying amount if there was a revaluation. Right. Then accumulated depreciation.
Yes.
Right. Our land is now 600,000. Right. This is now 600,000. And there's no depreciation, zero. Right. Our building will no longer be recording at its original cost of 639,800. It will now be recorded at its revalued amount, which is the 6.4. That will be the gross carrying amount. And
So at the carrying amount at the end of the year, you add those two, the cost and the revaluation during the year. How did you get the 600? Sorry, sir.
Which one?
The one at the cost
Land.
of gross carrying.
It was given.
Oh, okay.
Yeah.
Okay.
The new value, the revalued amount.
Okay.
All right, so it's now 6.4. So and our depreciation will now be only the one for this year. When we revalue the building, the depreciation for the previous period is written off.
Can you please repeat that, sir? When we
revalue a building, all the depreciation for the previous years can be written off against the asset. So it will no longer be there. So this one will no longer exist in the books.
Okay.
Is that right? It's one of the approaches, and I think this is the one that they were using here.
Okay.
All right, I think let's see.
I wonder if they do say, or it's how you'll be doing this all the time.
I think it's not an issue because they won't examine you on depreciation on revaluation of buildings. But here they said that on revaluation, accumulated depreciation is eliminated
Okay.
against the gross
Okay.
carrying amount of the asset. So it will no longer be there in the books. Right. Then our machinery, our cost is now the 1920 plus the 600. As long as there's nothing sold, you just add the cost at the beginning of the year plus the additions. Is that right?
Yes, sir.
And our accumulated depreciation will be the 384 plus the what? The 363.
Yes, the 363.
So that's it. But where we should be very careful is on the delivery vehicles. Right.
Yes.
We know that cost at end of year right, A would be equal to the cost at the beginning of year which is the 1.6. Is that right? Then we
Yes, sir.
add the cost of additions, which is equal to the additions here, the 360,000. Is that right?
Yes, sir. I'm following.
Then we subtract cost of disposal.
Just to the beginning of the year plus.
The one which was disposed of, its cost was 240. It had been bought at 240. Is that right?
Yes, sir.
All right. So that will give us the cost at end of year. That's the cost at end of year.
Okay.
Then accumulated depreciation
And
at end of year. Right. You'd say your accumulated depreciation at the beginning of year which is what?
cumulative depreciation.
640.
Yes.
This one here. It was given on the question, isn't it? In fact, we calculated it.
Yes.
Remember that we knew we calculated this cost of 1.6. Now that we asked 5/3.
Oh, okay. Okay.
Then
But
then this one, the 960 was given. So we just said 1.6 minus 960 to get
oh,
this.
yes. And then we got this. Yeah.
So it's 640. Right.
Yes.
Then we add the depreciation for the year.
Mm-hmm. Depreciation.
Which is this one here.
Yes.
Is that right?
Yes.
Then less accumulated depreciation on disposals.
Mm-hmm. 120.
Which is equal to this one here. We calculated it here.
Yes.
Then we get our accumulated depreciation at the end of year. So these calculations are only necessary if there was something sold and something bought.
It means if there was
If there was nothing sold, it was there was no
just
need for
take
that.
it.
We're just going to do what we did on the machinery, just adding the cost plus the additions. Then that's our cost. Our depreciation is going just to add this and this only. But now, if it's there's a disposal, that's when we have to do these other calculations.
Yes, sir.
Right. So that means our cost is this one here, and our accumulated depreciation is this one here.
Yes.
Right. Right. Then here you are supposed to write a statement that the land and buildings were revalued. The land and buildings are situated. That is the address that were given.
Yes.
On ERIF, that is if it is given.
Yeah.
ERIF 401, Boomspread. And were revalued by an independent sworn appraiser. Sworn appraiser on 1 March 2016. So you write that statement as long as there was a revaluation.
Yes.
So that is our property, plant and equipment note.
Yeah. Looks clear.
Any questions?
No, sir. It all looks clear when you're around.
You said what?
It all looks clear when we are around.
Wait. Then we have our investment property.
Until the paper is there, yes.
All right, we'll have our land, our buildings, then total.
Yes.
Right. We'll have our carrying amount at the beginning of year.
Yes.
Right, our investment property. We were told that they acquired this property on 1 March, so that means it was not there, isn't it?
Yes.
So that means from last year it was not there. Remember that our year started in 1 March. So that means last year we didn't have anything. Then we'll have additions during year. Right, our land, 1 million. Our building, we calculated the cost. Yeah. Remember, there was an improvement. So the original cost of the building plus the improvements. Is that right?
Mm.
Then we have that. Right. Then we've got fair value adjustments. Right. On the land, we calculated the fair value adjustment. We found it to be 100,000. This one here. So that will be 100,000. On the building, we calculated the fair value adjustment. We found it to be 450. Yeah. Is that right?
Yes.
Then we get our carrying amount at end of here. Right. Again, the investment property is situated on stand 65 Sportsback. And was revalued by an independent on appraisal. Right. Is that okay?
So I'd assume the investment property, it only includes the land and buildings.
You said what?
I'm saying I would assume that this investment property, it only involves the land and buildings, not
Yes.
other things.
Yes, it's only the land and buildings.
Okay.
Investment property are buildings that are rented out.
Okay.
So it's land and buildings.
Okay.
Only. Right.
Okay,
So that's
so-
it on that note.
Okay.
So that was the answer for this part, which was the
Mm.
major one for 37 marks.
Mm.
Right.
Mhm.
Then prepare an extract of the asset section of the statement of financial position of ProX at 28 February 2017. Right. Extract of the statement of financial position.
Mm.
Assets ProX Limited for the year ended 20 February 2017. Right. We have our assets, non-current assets. And non-current assets, we have property, plant and equipment. Right, your property, plant and equipment, you add the total of the carrying amounts at end of year. This one there, we add them together. Is that right?
Yes, sir.
So that will be 600,000 plus 6,023,529
$1772,800. 1772,800. 1772,800.
1772 plus
868
18
plus 868,000.
right, what do we get?
Nine two six four 329.
Oh, that becomes too big. You said 9264329.
9264 329.
Okay. Then investment property. Investment property is also a non-current asset. We take the total that we had here.
Yes.
Sorry, this one here.
No, 41.
No.
4100.
Right. Then we check if there are any other non-current assets. The other non-current assets can be financial instruments.
Okay.
Like these investments here. If they are not for trading, if they are held through other comprehensive income. So number 5, we're told that the investments of ProWorks Limited consisted of the following: 7,000 ordinary shares in Roads Limited, originally acquired at cost of 14,000. These shares are held as part of a long-term investment portfolio for capital appreciation. These shares are listed and traded on the JSE Limited. The market value of these shares on 28 February 2017 was 3 Rand per share. So these ones will be a non-current asset. Is that right?
Yes, sir.
Because they are held for what? This is a long-term investment.
I have for
Long-term
investment. Yes.
Right, then the other one, 5,000 ordinary shares in Spike Limited purchased on 28 February 2017 at the fair value of 25,000. These shares are to be held for trading.
For trading.
So these ones are current. Is that right?
Yes.
So would you have these ones would be the what? The non-current. Right. If you hold in a shares in a subsidiary whereby you hold more than 50%, you also have to state that these are investment in subsidiary. But this one they didn't tell us whether it's subsidiary or what. So we can say financial assets. Right. We record them at their new value, which is 7,000 multiplied by what?
3 something. 3.
It's now 3 Rand.
Um,
So we no longer record them at their original value. We record them at the new value. Is that right?
Okay.
So you only include them under non-current assets if they say they are not for trading. Is that right?
Yes.
In other words, they can also say that they are held through other comprehensive income. When they say they are held at fair value through other comprehensive income, you know that they will come here. And also, we also include in financial assets fixed deposits that will be repaid after more than a year, or loans that we give out to others that will only be repaid after more than a year. Right.
Okay.
Then current assets.
But those loans, are they going to be added or subtracted? They're going to be
We add.
subtracted.
We add. We are
The
not saying
loan.
loans that we took, loans that we gave someone else. That would be an asset.
Okay.
But the loans that we took, their liabilities, they don't go under assets.
Okay.
Like the company can give another company loan. That would be an asset.
Yes.
So you would add it under the assets. If it's a long term, that means to be repaid after more than a year, it will be non-current asset. If it's to be paid within a year, it will be current asset.
Yes.
Right. Then our current assets, we have inventory. Right. Our inventory here at year end on 28th February, the directors of ProWorks Limited determined that the net realizable value of inventory as follows. Right. A inventory is recorded at cost or net realizable value, whichever is lower. Is that right? Inventory is recorded at cost or net realizable value, whichever is lower. Right. The raw materials are now 5% below cost. So we're going to record them at net realizable value because it is below cost. Is that right? The net realizable value is lower, so we record at net realizable value.
Okay.
Because they say that the net realizable value is 5% below cost. So our net realizable value, that means it's 5% below this one. So we'd use the net realizable value. Right, the work in progress is above cost, so we will not adjust to record them at the 400,000. Is that right? We only adjust if the net realizable value is below cost.
Okay.
Only if.
The statement says that the debt determined that the net realizable, okay, the net realizable is below the cost. If it's below the cost, then we use
the net realizable value.
We adjust the net realizable value.
No. This one is the cost. We record at the net realizable value.
Okay.
So we have to calculate what is that net realizable value, which will be 95% of this. Okay. My 95% is coming from 100 minus 5.
5, yes.
So you only use the net realizable value if it is below the cost.
Okay.
If it's above the cost, we don't use it. So we're not going to, for the work in progress, we're not going to use the net realizable value. For the finished goods, it's exactly equal to cost, so there's no problem. So our inventories here, we're going to say, I want you to see here. Inventories.
Below cost.
Right. Our raw materials will take the net realizable value, which will be 280,000 times 95%. My 95% is coming from. Yes.
No, sir. I'm following. I was just writing down.
Okay. Now my 95% is coming from 100. 100 plus what? Minus 5.
Minus 5, yes.
The work in progress, we take it as it is because it is already above cost. So we use the cost. Then the finished goods, the cost and the net realizable value are the same. So we just take it as it is. So the one that you only adjust is the one that is below cost.
Okay. I understand.
Right. What do you get?
$766,000.
766,000. Right. right? A 66,000. Then we also have the financial instruments, financial assets. The other one that is for trading. Is that right?
Yes, sir.
We are told that these ones are for trading.
Mm-hmm.
Purchase on 28, their fair value of what? These ones were purchased at the end of the year, so they are already 25,000. This is at the end of the year, so just take that 25,000. But if they the new value, we're going to use the new value, right?
Mm-hmm.
These are the only assets that we have.
Okay.
Then we add then we get the total assets. Right. So this is how we prepare the asset section of the statement of financial position. The equity section is just like the one that we did last week.
Yes.
It's the statement of what we had on the statement of changes in equity. That's what we include when we are doing the equity portion.
Okay.
Any questions?
No, sir.
Okay. So thank you so much. I wish you all the best. So we'll meet next week.
Thank you so much.
Thank you.